Welcome back here with the insurance series on Money, Money, Money. And this week we are talking about life insurance. So we've been discussing a lot of the savings-based products or investment-oriented products that are offered by life insurance companies and whether they make sense for you or not. Now, the question I want to ask you, Harsh, is this. How do you know in that, money that you're paying every year, let's say you're paying 5 lakh rupees every year for a certain number of years, how much is the premium, how much is actually going into investment, where is it being invested? So how does one figure out that?
Well, Shruti, within the investment-oriented policy, there are two kinds. One is the traditional policy that we spoke about, endowment, money back, and the whole life plans. In these kind of policies, you're paying your premium. The company decides where the money is getting invested, and they follow a guideline given by IRDA. So there's an investment pattern that they have to follow. Now, the other element of an investment-based product is a ULIP, the unit-linked insurance plans. Now, these products are designed giving control of the investment in the hands of the policyholder. So when you make an investment, you pay a premium to into the policy. You also have to indicate and inform the insurance company how do you want this money to be invested. So there will be certain premium allocation charges, which is the entry load in that context. There's a charge that the insurance company levies. So a certain portion will be deducted from the money that you've paid. Then the money gets invested in the form that the policyholder tells them to do. So it could go into an equity fund, it could go in a balanced fund, it could go into a debt, and there are different options which are given by the insurance company. So there you would have complete control over what is happening with your money.
Sure. So Rahul, let me get you in on this. When we're discussing savings-oriented or investment-oriented products, ULIP being one such type, there was a point in time when they were being sold very, very aggressively by the industry. Now, not so much. But how do you rate them as a product, and how do you compare them with the traditional products like a money-back policy or an endowment policy?
See, I find ULIPs are a very good, they are very good products. They got a very bad name because, it's actually lack of awareness, if you ask me. What happens in ULIPs is, when you see a policy document, the charges are upfront mentioned in the ULIP. What he said, there's a loading charge, right? So let's say in a ULIP, there's a 40 or 50% charge with the insurance company is taking. But what people don't know, in a traditional plan, right, the charges are actually more than 100%. Right? The only thing is it is not transparent in any policy. Be it ULIP, be it traditional, there are three components. One is the term portion, which is the risk cover portion. One is the expenses of the insurance company. Third is the balance money, which goes into the savings. Right? So term insurance portion is practically same for all insurance companies, right? If it's a 10 lakh rupees term cover, it's practically same for every insurance company. Coming to the charges, now this is where the catch is, right? In ULIPs, they used to show very clearly the charges is 20% or 30% or 40%.
And that's the portion that's going to the insurance company?
Yes, right? For their expenses, for commissions, for whatever, management expenses. Now this charge is not specifically mentioned in a traditional plan, where normally it is much higher than what is there in the ULIP.
So if I'm paying, let's say in a year, if it's a, it's a traditional plan, I'm supposed to pay, let's say, a 5 lakh rupee premium. So that's the breakup that I was asking for, or maybe a 1 lakh rupee premium. So what the breakup
the entire
is?
5 lakh rupees is going towards expenses of the insurance company.
Oh, really?
Yes, it can be as bad as that. See, because if you see the long-term rate of return in any traditional product, none of the products from any company, including LIC, can give you more than 5.5% IRR. Whereas a ULIP would easily give you even today 8 to 9% IRR in a balanced fund.
But that's also because the ULIP will have a higher equity exposure typically.
Yes, both the factors are there, because in traditional plans, most of the money, 95% of the money goes into government bonds and securities, debt market, where you only get 7-8%. But charges are also a very important factor in that. Right? The load is much higher in traditional plan compared to ULIPs. But now after this, one good thing has happened is, so in ULIP there were high charge ULIP, there were low charge ULIPs. In some of the ULIP products, the charges were 70 to 80%, which was criminal, of course. Now, because of all this, consciousness and
the regulator also came down quite harshly.
And now normally the charges are not more than 20%, which is fantastic if you ask me.
Now, your sense on this, if we're comparing all different types of savings, products, saving insurance products, then what's the best bet?
When you come down to choosing a product within the insurance gamut, then of course you will choose as per your risk appetite or your attitude towards investment.
Sure.
The bigger question is, is this the only investment option do I have? So while I want to take a risk coverage, term plan is what I have offered by an insurance sector. The question is, if I want to manage my own money and if I'm prudent enough to take decisions, can I not look at pure investment plans? Could be mutual funds, could be even
direct equity, or looking at the other investment, direct investment.
Absolutely. I could look at PPF for that matter. I could look at a recurring deposit. I could look at all other elements which have nothing to do with insurance. What is it that I get extra when I combine the both? If I have
and you're paying such charges. I mean, even if they've come down to 20%, it's still a charge. And it sounds to me that it's more expensive to go through this route than to invest directly in a mutual fund.
That's exactly what I was trying to. Within the insurance gamut, if you're choosing, then obviously you will choose as per your risk appetite and your attitude towards investments. However, if you're looking at a pure investment product, there are much better avenues. However, having said this, there are certain inherent benefits of even investing in insurance policies.
What are those benefits?
So one is, if you invest into a debt product, if you invest in a debt fund of a mutual fund, okay, and you switch out or you redeem within 1 year, okay, there's a tax element to it.
Right.
You may be wanting to stay invested for more than 5 years. However, as an asset allocation plan, you've got say 30% into debt, 70% into equity. However, and you rebalance it after a year.
Yeah, there is a tax implication.
There's a tax
if you're moving
implication
your money around in less than a year.
Yes, so there is a tax implication on that. However, we do as many number of switches within equity to debt and back to equity within that year also. And
it's a life insurance product, so you're covered under ATC, I'm guessing, right?
Absolutely.
So there's no tax implication.
So there is no tax implication on that count.
But you covered up till the limit of 1.5 lakh rupees. I mean, let's not forget that. And the investment might be, significantly higher.
Yeah, but the issue is when you take money out after 10 years, whether it's going to be tax exempt or it's not going to be. So within the tax, insurance gamut, there's a clause which also says that the money that comes back to you is tax-free.
Fair debate and fair point. And of course, it's a personal call whether you want to go for term insurance or whether you also want to dabble with some of the savings and investment-oriented life insurance products. But something else that we're going to talk about after the break. Annuity as a concept and some of the riders that you can attach along with your life insurance policy. We're coming back in just a bit.